Hey everybody. I'm going to talk just a little bit about an underutilized estate planning tool called a GRAT, or a Grantor Retained Annuity Trust. This is an important tool, especially right now, for a few reasons I'm going to cover very briefly. So hopefully this is going to be no more than a minute or two. So a very quick and dirty look at what a GRAT is and what it does and why right now is the right time to have one. So let me pull up some slides. GRAT, Grantor Retained Annuity Trust. What is it? Who needs it? First of all, a lot has changed since the COVID-19 crisis, and a lot of it's affected our economy, not just in terms of jobs and getting out of the house, but also in terms of interest rates. And that second part, the interest rate component, is what really makes this an opportune time to create a GRAT if you happen to be in a certain socioeconomic demographic. So why is right now the right time to create a GRAT for a lot of people? First of all, there are depressed asset values, stocks, mineral interests, business interests. A lot of assets that are in sort of high net worth folks' portfolios right now are at a lower than optimal valuation. And that's actually a good thing for purposes of GRAT. So because asset values are depressed, right now is important. The second part of this is that the IRS every month publishes something called a 75/20 rate, which is the rate that applies to things like interfamily loans and transfers to certain types of estate planning tools like family limited partnerships and GRATs and intentionally defective grantor trusts and other important tools. And the third thing that has been around for a couple of years, but it's still an important piece of how this all comes together right now, is that in 2025, the current estate and gift tax exclusion amounts are set to sunset, which means they're going to be cut in half. So right now, if you're an individual and you passed away before 2025, you would have to be worth more than $11.8 million to owe any estate taxes. And if you're married and you file for portability, then you'd have to be worth more than $23.16 million to owe any estate taxes. So you have to be incredibly high net worth. There's only 1,500 or 1,600 families nationwide that have that problem. But in 2025, all of that's going to get cut in half. So folks, individuals that find themselves between $4 and $6 million in total assets, and couples that find themselves anywhere from $9 to $12 million, this is an opportune time because your asset values are depressed, the 75/20 rates are incredibly low, and in just a few years, this current estate tax exclusion amount is likely to sunset. So what is a GRAT? What's a Grantor Retained Annuity Trust? What happens is that the grantor, you transfer certain appreciable assets, these depressed value assets, your business interests, your brokerage, your minerals, etc., into this irrevocable trust for a fixed period of time, 2 to 10 years. During that period of time, the grantor is going to receive an annuity. In other words, that what you put into that trust is going to come back to you each year over the term of that GRAT. And it's going to be calculated using the 75/20 rate, which right now is historically low. It's at 0.8%. And to give you some perspective, that number last year in May was over 3%. So a lot of what you have invested in that GRAT stays in the GRAT, and just a little bit of interest comes back to you. That's a good thing because you want the assets that are in that GRAT to grow. And all of that growth occurs outside of your taxable estate. When you pass away, those assets are not subject to the estate tax amount. So money that you've transferred into the GRAT comes back to you as an annuity with a little bit of interest, and everything that stays in there grows outside of your estate. So if you happen to be in that net worth that I mentioned, or an individual worth between 4 and 6 million, or a couple worth between 9 and 12, you wouldn't owe any estate taxes if you died before 2025 because the exemption amounts are so much higher. But if the law changes in 2025 and sunsets, you likely will owe some estate taxes. Or if Congress acts between now and 2025 to lower that amount because they got to raise revenue somewhere, the government's bleeding money at this point, and they're going to find cash somewhere. Estate taxes are always low-hanging fruit. There's already conversation about lowering that amount significantly. So if you happen to be in that net worth ballpark, this is the right time to create a GRAT transfer assets with a depressed value into it. As the assets increase in value, all of that increase happens outside of your estate. You get your initial principal investment back as an annuity plus a little bit of interest, and all that growth happens in a non-taxable way. So you've solved an estate tax problem. You've recovered a lot of the value that you put in there. You're not losing that money. Your beneficiaries get all that growth at the end of the term, and you have significantly decreased the potential that you have a taxable estate. If that raises questions, and you want somebody to talk to about that, please contact us. Our contact information is here on the channel if you're watching this on YouTube or on Facebook or on the website. But the website is tallgrassestateplanning.com, and our phone number is 918-770-8940. Reach out to us and we'll talk about that.